You know what's interesting? While everyone's been watching gold hit new highs, something extraordinary just happened in the silver market that most people completely missed. And if you're a retiree who's been stacking silver, or you've been thinking about it, what I'm about to show you could be the validation you've been waiting for. Silver just hit an all-time record high of $64 per ounce on December 11th. Let me say that again, because it's important. Silver, the metal that's been called poor man's gold for decades, just shattered every record in its history. We're not talking about inflation-adjusted highs. We're talking about nominal, actual dollar highs. The previous record from 1980, obliterated. The 2011 peak, left in the dust. But here's what makes this absolutely fascinating. Within days of hitting that record, silver pulled back about 3% as some traders took profits. And you know what the mainstream media did? They called it a correction. They said the rally was over. They suggested maybe silver had gotten ahead of itself. They couldn't be more wrong, because what they're not telling you is why silver hit that record in the first place. And more importantly, why this pullback might be the last chance to get in before something much bigger happens. Let me walk you through what's really going on here. Silver is up 121% in 2025 alone. Think about that for a second. If you put $10,000 into silver on January 1st when it was trading at $28.92, you'd be sitting on $22,100 right now. That's not a typo. That's a 121% gain in less than 12 months. How many retirees do you know who made 121% in their stock portfolios this year? How many bond funds delivered anything close to that? But here's where it gets really interesting. This isn't just about price. This is about something fundamental changing in the silver market, something that's been building for years and is now reaching a critical point. The rally is being driven by three forces that are all converging at the same time: tightening inventories, sustained industrial demand, and something the financial media barely mentions: massive institutional accumulation. Let's start with inventories because this is where the story gets fascinating. The COMEX, which is the major exchange where silver futures are traded, has been seeing its registered silver inventories, the silver that's actually available for delivery, dropping to levels we haven't seen in years. We're talking about the physical metal that backs up all those paper contracts, and it's disappearing. Now, you might ask, where's it going? Some of it's going into industrial applications: solar panels, electronics, electric vehicles, 5G infrastructure. Silver is the most conductive metal on Earth. You can't build the green energy future without it. You can't manufacture advanced electronics without it. And as countries around the world push for electrification and renewable energy, that industrial demand isn't just growing, it's accelerating. But that's only part of the story. A significant amount of that silver is being taken off the market by investors who are converting paper silver into physical metal and storing it outside the banking system. They're doing what's called standing for delivery. Instead of just trading contracts back and forth, they're saying, I want the actual metal. And once that metal leaves the COMEX vaults, it rarely comes back. Think about what that means. Every ounce of silver that gets converted from a paper contract into physical possession is one less ounce available to satisfy future delivery demands. It's a one-way door, and more people are walking through that door every single day. Now, here's where this connects to retirees specifically. There's a demographic shift happening that nobody's talking about. Baby boomers, the largest generation in history, are retiring at a rate of about 10,000 people per day, and many of them watched what happened in 2008. They saw their 401ks get cut in half. They saw their home values collapse. They saw their retirement dreams evaporate. Those people learned a hard lesson about counterparty risk, about what happens when your wealth is just numbers on a screen, controlled by institutions that can fail. And now, as they look at inflation eating away at their purchasing power, as they watch the national debt spiral past $36 trillion, as they see geopolitical tensions rising around the world, they're asking themselves a very simple question: how do I protect what I've spent my entire life building? For many of them, the answer is physical precious metals, and silver, with its lower price point compared to gold, has become incredibly attractive. You can buy meaningful quantities of silver without needing 6 figures of capital. A retiree with $50,000 or $100,000 can build a substantial silver position. Try doing that with gold at $2,700 an ounce. So you've got this perfect storm: industrial demand that's structural and growing, investment demand from a generation that's learned not to trust the system, and inventories that are tightening because the physical metal is being pulled out of the system faster than it's being replaced. And then, on top of all of that, you've got something else happening that's absolutely critical to understand: the gold to silver ratio. For most of modern history, silver has traded at a ratio to gold. Sometimes that ratio is 50 to 1, meaning it takes 50 ounces of silver to buy 1 ounce of gold. Sometimes it's 80 to 1. During the March 2020 panic, it briefly spiked to 125 to 1. Right now, with gold around $2,700 and silver at $64, we're looking at a ratio of about 42 to 1. Now, here's what's fascinating about that. Historically, when silver starts outperforming gold and that ratio compresses, it tends to keep going. We saw it in 1979-1980 when the ratio got down to 17 to 1. We saw it in 2011 when it briefly touched 32 to 1. Why does this matter? Because if silver continues to close that gap with gold, if that ratio compresses to even 35 to 1, you're looking at silver prices well above $75 per ounce. If it gets to 30 to 1, which is entirely possible based on historical precedent, you're looking at $90 silver. And here's the thing that should make every retiree who's been stacking silver sit up and pay attention. This isn't speculation. This is math based on historical patterns and current market dynamics. But let me show you something even more interesting. Central banks around the world have been accumulating gold at record levels. In 2024, central bank gold purchases hit the second highest level on record. Countries like China, Russia, India, Turkey, they're all buying gold hand over fist. Why? Because they're diversifying away from the dollar. They're preparing for a world where the dollar isn't the undisputed reserve currency. Now, most central banks don't buy silver. It's too bulky, too industrial, not traditional enough for their reserve holdings. But you know who does buy silver? Sovereign wealth funds, private institutions, family offices, the smart money that doesn't have to follow central bank protocols. And they're buying it quietly. They're not announcing it. They're not putting out press releases. But if you watch the flows, if you track the inventories, if you pay attention to what's happening in the physical market, you can see it. There's a reason silver ETFs have been seeing inflows. There's a reason mints around the world are struggling to keep up with demand for silver coins and bars. There's a reason premiums on physical silver have been elevated for months. The smart money is positioning for something. Now, let me address something important here because I know some of you are thinking, but silver just pulled back 3% from its high. Doesn't that mean the rally is over? No. And here's why. Every major bull market has pullbacks. In fact, healthy bull markets need pullbacks. They shake out the weak hands, the traders who are just chasing momentum. They create opportunities for long-term investors to add to positions. Look at what happened in 2010-2011. Silver went from $18 to $49 in about 18 months. But along the way, it had multiple 10-15% corrections. Each time, people said the rally was over. Each time, they were wrong. The difference between traders and investors is time horizon. Traders see a 3% pullback and panic. Investors see a 3% pullback after a 121% gain and recognize it for what it is: a normal, healthy consolidation in an ongoing bull market. And here's what makes this particular moment so compelling. We're not just in a silver bull market. We're in a precious metals supercycle driven by forces that aren't going away: monetary debasement, geopolitical fragmentation, the transition from a unipolar world to a multipolar world, the loss of faith in fiat currencies. These aren't temporary conditions. These are structural shifts that will play out over years, possibly decades. And silver, because of its dual nature as both a monetary metal and an industrial metal, is positioned to benefit from all of it. Think about the industrial side for a moment. Every electric vehicle uses about twice as much silver as a traditional car. Every solar panel installation requires significant amounts of silver. The build-out of 5G networks, the expansion of data centers for AI, the electrification of everything, all of it requires silver. And here's the kicker. Unlike gold, which is primarily a monetary metal that gets recycled and reused, silver gets consumed. When you use silver in a solar panel or an electronic circuit board, it's gone. It's not economically viable to recover it. That silver is effectively removed from the supply forever. So you've got growing industrial demand that's consuming the metal, and you've got growing investment demand from people who want to own physical assets outside the financial system. And you've got a supply situation where primary silver production has been relatively flat for years. Do you see the setup here? This is why the recent record high isn't the end of the story. It's the beginning. Now, I want to take a quick aside here because this is relevant for many of you watching. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs or 401ks, you might not know that you can actually hold physical precious metals in a retirement account. It's called a gold IRA, though it can hold silver too. I put together a free guide that explains exactly how it works, how to do it without triggering taxes or penalties, and what you need to know. It's in the description below. Worth checking out if you're thinking about diversifying your retirement holdings into physical assets. All right, back to where this market is headed. Let's talk about what happens next, because this is where it gets really interesting. Silver has a history of explosive moves. It doesn't grind higher slowly like gold often does. Silver tends to consolidate for long periods, building energy, and then it erupts. We saw it in 1979, 1980. We saw it in 2010, 2011, and we're seeing the early stages of it right now. The 121% gain in 2025 is impressive, but if history is any guide, it might just be the warm-up act. In 1979, silver started the year around $6. By January 1980, it had hit $50. That's more than an 8x move in about 12 months. Now, I'm not saying we're going to see an 8x move from current levels. The market is different, the world is different, the scale is different. But the point is, when silver moves, it moves fast, and it moves far. In 2010, silver was trading around $18. By April 2011, it hit $49. That's a 172% gain in about 16 months. And that happened in a world where the financial system was recovering from 2008, where central banks were just beginning their quantitative easing programs, where the debt levels were a fraction of what they are today. Now fast forward to today. The national debt is $36 trillion and growing by $1 trillion every 100 days. The Federal Reserve's balance sheet, even after some reduction, is still massive by historical standards. We've got ongoing conflicts in Ukraine and the Middle East. We've got tensions between the US and China. We've got BRICS nations actively working to create alternatives to the dollar-based financial system. And we've got inflation that, despite what the official numbers say, is still eating away at purchasing power. Go to the grocery store. Look at your insurance premiums. Check your property taxes. The cost of living is not going down. Not going. This is the environment we're in. And in this environment, hard assets, tangible assets, assets that can't be printed or debased, become increasingly valuable. Silver is one of those assets. But here's what makes silver particularly interesting compared to gold. The silver market is much smaller. The total value of all the silver in the world, if you could gather it all up, is a tiny fraction of the gold market. Some estimates put the entire above-ground silver supply at around 2 billion ounces. At $64 per ounce, that's about $128 billion. Compare that to gold. There are roughly 200,000 metric tons of above-ground gold, which is about 6.4 billion ounces. At $2,700 per ounce, that's over $17 trillion. Do you see the difference in scale? The silver market is so much smaller that it doesn't take nearly as much capital to move it. When institutional money starts flowing into silver, when countries start accumulating it, when investment demand really kicks in, the price can move dramatically because there simply isn't that much silver available. This is what's known as the silver squeeze potential. And it's not a conspiracy theory. It's basic supply and demand in a market with limited supply and growing demand. Now let's talk about what retirees specifically should be thinking about here. If you're retired or approaching retirement, your investment strategy is different from someone in their 30s or 40s. You can't afford to take massive risks. You need to preserve capital. You need income. You need stability. But here's the paradox. In a world of monetary instability, what feels safe might actually be risky. And what feels risky might actually be safe. Holding all your wealth in dollars, in bonds, and financial assets that are just claims on future payments, that might feel safe because it's familiar. But if the dollar loses purchasing power, if inflation continues to erode your savings, if the financial system experiences another crisis, those safe assets can lose value quickly. Physical silver, on the other hand, might feel risky because it's volatile, because the price moves around, because it's not what your financial advisor typically recommends, but it's a tangible asset. It has intrinsic value. It's been money for thousands of years, and it can't be devalued by a central bank printing more of it. The question isn't whether silver is risky. The question is, what are you trying to protect against? If you're trying to protect against short-term price volatility, then yes, silver might not be ideal. But if you're trying to protect against long-term purchasing power erosion, against monetary debasement, against systemic financial risk, then silver starts to look very different. And here's something else to consider. Silver is divisible in a way that gold isn't. A 1-ounce gold coin at $2,700 is a significant amount of value in a small package. That's great for storing large amounts of wealth, but it's not very practical for smaller transactions or for gradually converting back to currency if you need to. Silver, at $64 per ounce, is much more flexible. You can buy it in smaller increments, you can sell it in smaller increments, it's more liquid in practical terms for most people. This is why so many retirees are stacking silver. It's not just about speculation or trying to get rich. It's about having a tangible store of value that's outside the banking system, that can't be frozen or confiscated, that will hold its purchasing power regardless of what happens to paper currencies. Now let me show you something that I think really drives this home. In 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold, silver was trading around $150 per ounce. Today it's at 64, that's a 42x increase over about 54 years. But here's what's really interesting. If you adjust for the expansion of the money supply over that same period, silver should theoretically be much higher. The M2 money supply, which is a measure of the total amount of dollars in circulation, has increased by more than 40x since 1971. In other words, silver has basically kept pace with monetary inflation over the long term. It's done exactly what it's supposed to do as a store of value. It's preserved purchasing power. But here's the thing. Silver hasn't moved in a straight line. It's had massive bull markets and brutal bear markets. The people who did well with silver were the ones who accumulated it during the quiet periods and held it through the volatile periods. We're coming out of one of those quiet periods right now. From 2011 to 2024, silver was in a bear market or a consolidation phase. It ranged mostly between $14 and $30. It was boring. It was frustrating for people who bought at the 2011 highs. But it was also an opportunity for patient accumulators. And now, in 2025, we're seeing the breakout. We're seeing silver wake up. We're seeing it start to move the way it moves when a real bull market is underway. The retirees who have been stacking silver over the past few years, buying a few ounces here, a few ounces there, building a position gradually, they're the ones who are sitting on significant gains right now. They're the ones who are seeing their foresight validated. And the good news, if you haven't started yet, or if you want to add to your position, is that this pullback from the record high might be giving you a second chance. Because here's what typically happens in precious metals bull markets. The metal makes a new high, pulls back, consolidates, and then makes another leg higher. Each pullback shakes out the weak hands and creates a base for the next move up. We saw this pattern in gold from 2019 to 2024. Gold would make a new high, pull back 5 to 10%, consolidate, then make another new high. Each time, people said the rally was over. Each time, they were wrong. Silver is following a similar pattern now. The record high at $64 was the breakout. This pullback to around $62 is the consolidation. And if the pattern holds, the next leg higher could take silver to levels that seem unthinkable right now. Some analysts are talking about $75 silver. Some are talking about $100 silver. The more aggressive ones are talking about $150 or even $200 silver if we get a real mania phase like we saw in 1980. Now, I'm not going to make specific price predictions because nobody knows exactly where this goes, but what I will say is this. The fundamentals for silver are stronger than they've been in decades. The supply-demand dynamics are tightening. The monetary backdrop is supportive. The geopolitical environment is uncertain. And the technical breakout suggests that a major move is underway. For retirees, this represents an opportunity that doesn't come along very often. The opportunity to own a tangible asset that's breaking out to new highs, that has both monetary and industrial demand, that's in a structural bull market driven by forces that aren't going away. But it also represents a responsibility. Because if you're going to own silver, you need to understand what you're buying and why you're buying it. You need to have realistic expectations. You need to be prepared for volatility. And you need to think long-term. Silver is not a get-rich-quick scheme. It's not a lottery ticket. It's a store of value, a form of wealth insurance, a hedge against monetary instability. The people who do well with silver are the ones who buy it with money they don't need for immediate expenses, who hold it through the ups and downs, who view it as a long-term position rather than a short-term trade. And here's something else that's important to understand. When you buy physical silver, you're not just buying a commodity. You're buying independence. You're buying security. You're buying peace of mind. Because when you hold physical silver in your possession or in a secure vault that you control, you own it outright. It's not a claim on someone else's promise. It's not dependent on a bank staying solvent or a government honoring its obligations. It's yours. In a world where so much of our wealth is digital, where it exists only as entries in computer systems, where it can be frozen or seized or devalued at the stroke of a keyboard, there's something profoundly reassuring about holding real, tangible wealth in your hands. This is why silver has been called the people's money throughout history. It's accessible, it's affordable, it's real. And right now, with silver breaking out to record highs, with the fundamentals supporting higher prices, with the technical picture looking strong, the people who have been stacking silver are getting validation that their strategy was correct. The good news is that it's not too late. This bull market is still in its early stages. The industrial demand story is still playing out. The monetary debasement is still accelerating. The geopolitical tensions are still rising. All of the factors that drove silver to $64 are still in place, and many of them are intensifying. So if you're a retiree who's been stacking silver, congratulations. You made a smart decision, and it's paying off. Keep doing what you're doing. Use pullbacks as opportunities to add to your position if you have the capital and the conviction. And if you're a retiree who's been thinking about silver but hasn't pulled the trigger yet, this might be your moment. Not because you're trying to chase the rally, but because the fundamental case for owning silver is stronger than ever, and the technical breakout suggests that the market is confirming that case. Just remember, this is a marathon, not a sprint. Silver will have good days and bad days. It will have weeks where it surges and weeks where it pulls back. But if the long-term thesis is correct, if we're in a multi-year bull market driven by structural forces, then the day-to-day noise doesn't matter as much as the overall direction. And right now, that direction is up. The breaking news isn't just that silver hit a record high. The breaking news is that the fundamentals supporting that high are real, they're sustainable, and they're likely to drive prices even higher in the months and years ahead. For retirees who understand this, who have positioned themselves accordingly, who have been patient and disciplined in building their silver positions, this is the validation they've been waiting for. This is the moment when the strategy starts to pay off. And for those who are just starting to pay attention, who are just beginning to understand why silver matters, who are just now considering adding it to their retirement portfolio, the message is simple. You're not too late, but you shouldn't wait too long either. Because when silver really starts to move, when the momentum builds and the investment demand kicks in and the supply constraints become obvious to everyone, the opportunity to buy at reasonable prices disappears quickly. We saw it in 1980. We saw it in 2011. And we're likely to see it again in this cycle. The retirees who are stacking silver right now, who are taking advantage of this consolidation phase, who are building positions while the mainstream is still skeptical, they're the ones who will look back in a few years and be glad they acted when they did. This is your good news. This is your opportunity. This is your moment to take control of your financial future and protect what you've spent a lifetime building. Silver just told you something important by hitting that record high. It told you that the bull market is real. It told you that the fundamentals are working. It told you that the patient accumulators were right. The question now is, what are you going to do with that information?